September 16, 1992. The British government is in full panic. Interest rates, already raised twice in a single morning, are doing nothing. Billions of pounds are draining out of Britain's economy by the hour. The Chancellor of the Exchequer is on the phone, desperate. The Prime Minister is behind closed doors, watching everything fall apart. And somewhere in New York City, a man in a quiet office is watching the same news. And he is smiling. Because he didn't just predict this moment, he caused it. To understand what happened on that day, we need to go back a few years. In 1979, European countries created something called the exchange rate mechanism, the ERM. Think of it like this. Imagine a group of friends agree that no matter what happens, they'll always split the bill equally at dinner. Even if one friend is broke, even if another just got a raise, European countries agreed to keep their currencies within a fixed range of each other. If your currency drifted too far, your government had to intervene, either raising interest rates or buying your own currency to pull it back. Britain, however, stayed out of it for over a decade. The British were skeptical. They valued their independence. But in October 1990, under Prime Minister Margaret Thatcher, in one of her final acts in office, Britain joined the ERM, and almost immediately, the problems began. To join the ERM, Britain had to lock the pound at 2.95 Deutsche Marks. But Britain's economy in the early 1990s was in rough shape, unemployment rising, growth slowing, inflation high. Normally, a government would lower interest rates to encourage spending, but they couldn't because that would weaken the pound and break their ERM commitment. So, Britain was trapped. His name was George Soros. Born in Budapest, Hungary in 1930, Soros grew up under Nazi occupation. As a Jewish teenager, he survived by using a false identity. After the war, he moved to London, studying at the London School of Economics. He had almost nothing. He worked as a waiter, as a railway porter, doing whatever it took. Eventually, he made his way to Wall Street, and by the 1970s had founded his own firm, the Quantum Fund. Soros had a philosophy that was unusual among investors. Most people believed markets were rational, that prices reflected reality. Soros believed the opposite. He believed markets were driven by human emotion, bias, and perception. He called this idea reflexivity. In simple terms, if enough people believe something is true about a market, their belief itself makes it true, for a while, until reality catches up. In 1992, watching Britain struggle inside the ERM, George Soros saw a gap between reality and perception the size of a canyon. To Soros, this wasn't a gamble. It was a near certainty. What Soros did wasn't reckless. It wasn't luck. It was methodical, calculated, almost surgical. The strategy he used is called short selling. Imagine you borrow your neighbor's car worth $10,000. You sell it immediately. When its value drops to $7,000, you buy it back and return it, pocketing $3,000. Soros decided to do this with billions of pounds. His bet was simple. Britain will not maintain the pound's value inside the ERM. When it breaks, and it will, the pound falls. And when it falls, I win. Word spread in financial circles. Other hedge funds caught on. Other traders started making the same bet. By early September 1992, the pressure on the pound was enormous. The Bank of England was spending billions of its reserves every single day just buying pounds to keep the value up. It was like trying to hold back a flood with your hands. 6 a.m. currency markets open. The pound is already under pressure. The Bank of England begins buying pounds frantically, spending £1 billion in the first hour alone. 8:30 a.m. The situation is not improving. The Bank of England's reserves are draining fast. Emergency meetings are convened. 10:30 a.m. Chancellor Norman Lamont announces interest rates raised from 10% to 12%, effective immediately. In theory, money should have flooded back into the pound. It didn't work. 2 p.m. In a second desperate move, the government announces another rate hike to 15%, 2 rate hikes in a single day. Think about what that means for ordinary British people with mortgages and loans. Behind closed doors, Prime Minister John Major is being briefed. The situation is described as critical. The Bank of England has now spent an estimated £3 billion, and it is not working. 5 p.m. Norman Lamont walks out in front of cameras. He announces that Britain is suspending its membership in the ERM. The pound, freed from the fixed rate, immediately begins to fall. George Soros closes his position. In less than 24 hours, he had made a profit of over $1 billion. September 16, 1992 became known forever as Black Wednesday. For Britain, the immediate aftermath was humiliation. Black Wednesday became one of the most politically damaging events in modern British history. The Conservative Party never fully recovered. But here's the twist. In the long run, leaving the ERM was good for Britain. Freed from the fixed rate, the pound fell to its natural level, interest rates dropped, and the economy began to recover. As for Soros, in financial circles, he became a legend. But in Britain and many other countries, he became something closer to a villain. Critics argued his actions were predatory and destabilizing. George Soros didn't rob a bank. He didn't forge documents. He didn't break a single law. He simply looked at a situation that an entire government refused to look at honestly and acted on what he saw.